right now.
Great.
Awesome. Thanks everyone for joining today's webinar with Elizabeth Yin from Hustle Fund. We're going to let people filter on in before we get started. Super excited to introduce those of you that don't know Elizabeth in a second here. But before we get started, always get this question asked. So we're just going to answer it now, and I'm sure we'll answer it again. We are going to fully record this webinar. We'll make it available after. So if you registered for this webinar, you'll get the recording and right up after. We'll also put this on our blog and distribute it on our standard channel. So we will record this if you have to cut out early or just want to see a recap. So we will have that available for everyone and make it available after probably later on this week. But today, really, the topic is all about fundraising in today's environment. People can't seem to get enough of this, and I think I know why. And let me introduce Elizabeth. So Elizabeth is the partner at Hustle Fund, micro VC fund based in the Bay Area. Prior to that, Elizabeth was a partner at 500 Startups. I was just reading, actually, Elizabeth, your story about when you started a company back in the 08 kind of original financial crisis. And I want to get into the whiskey catalog. That sounds like a great side hustle. And talk about that. I've certainly got into dark liquor and whiskey tasting here in Shelter in Place. But now is the partner at 500 Startups. And for those of you that don't know me, my name is Mike Cruz. I'm the founder of Visible. We help we help startups report to their investors, build relationships with potential investors, and now manage their fundraising process. Elizabeth is actually we started doing this webinar series back in the fall of 2019, and I think you're our first guest. We've come full cycle. You're now our first repeat guest, and super excited to have you on today, Elizabeth. Maybe just for folks that don't know, can you just share a little bit about Hustle Fund? You know, where you guys are investing, what stages, how many portfolio companies you guys have currently?
Yeah, certainly. Well, first off, Mike, thanks so much for having me and having me back, I guess.
Yeah.
So yeah, I've been an entrepreneur before, as you mentioned, and more recently I started a fund called Hustle Fund. We're about 3 years old, and we call ourselves a quote pre-seed fund. The nomenclature is a little bit messed up these days, but what I mean by that is our sweet spot is where we invest in companies that have a product, but we don't care about traction. We don't ding people if they have traction, but we don't care if you don't have traction. And I think that's a little bit of an unusual offering for an institutional fund.
Awesome. How many portfolio companies you guys currently have?
We have about 160.
Whew. Oh man, how do you support all of those companies?
Yeah, so I mean, I think this is where people need to think about what they're looking for in investors. We don't take board seats. For better or for worse, some people want a good board, and a good board actually can be great. And we're not writing large checks either. We are a small fund. Our average check size is 25K. And so as such, we try to do things that scale a little bit more. We run a lot of programs, like we have a growth school that is several weeks long, and it goes into specific tactics and helps out our portfolio companies on their unit economics and iterating, their sales process, whether it's through online marketing or outbound sales or whatnot. We have a lot of different mentors who jump in there who have specific skill sets. So it's mostly through scaled things like that, rather than, we do a monthly meeting with you and that sort of thing. Yeah.
Okay. Awesome. So for those of you that just are rolling in right now, as I mentioned, we will have a recap and recording of all this. So if you have to leave early or just want to recap, that'll be sent out. And submit any questions via Zoom chat. So Zoom's got chat here. We have someone on our team standing by. We'll curate those questions, have them at the end of our webinar here. We'll try to keep this to a tight 45, so we're respectful of everyone's time. But please do submit any questions. We'll get to those at the end and get this recap out to everyone. So in terms of things, we thought would be great to cover today, just general state of the market. Things are kind of opening back up. You're seeing people on Twitter tweet about, in-person venture meetings now and seeing like what has changed over the last 90 days. How's that changed since last time we spoke with Elizabeth back in 2019, and how has fundraising just evolved? And then I want to spend a lot of time around this idea of supply and demand and the game behind this, or the strategy behind supply and demand and mechanics for fundraising. I think Elizabeth, you have a ton of great content, some recent items as well around this idea of supply and demand and how to strategically think about fundraising, and I think applicable now more than ever. And then understanding how VCs think to better odds of raising capital, right? Why do VCs chase these unicorns, and what does that mean? And putting yourself in their shoes so you can better optimize your chance for raising capital as a founder, and what happens if you can't. So maybe just to get started, Elizabeth, would love to hear just, what are you seeing in the market, both for, I guess, companies that are pitching and coming through your funnel at the Hustle Fund, but also current portfolio companies and what they're experiencing raising after they come through and you invested in those initial companies.
So I think first off, I would just say that fundraising in general, at all times, whether you're in good times or bad, is challenging for everybody, especially in the beginning, even for people who are very well networked. I'm sorry. Even if you're really well networked, it's just always hard to get momentum. And so I would say that that's just how it generally applies. But where we are in the cycle is compared to 2019. I would say 2019 was a great year for founders. It was always hard, but I think once you kind of got going, there were a lot of investors who were actively investing at that time. During COVID, the last 3 months, I would say that, there's certainly been some downs and I would say ups. And, a number of my portfolio companies, almost everybody actually had tried to raise initially in, I would say, early April or thereabouts. And it was just impossible. Nobody was really able to raise, more than, call it a couple $100,000 effectively. The big firms were basically saying, look, we've never done the Zoom thing. We don't know how to make decisions, or we're not willing to make decisions based on Zoom. We don't need to. So we're just going to kind of wait this out. And I think the people who were investing were generally small folks like ourselves and other microfunds, as well as angels. And so, of course, it's harder to pull together large amounts of fundraise, larger amounts of investing, large amounts of investments. And so it was really challenging, I think, a couple months ago. But now we're sort of in this weird stage where I'm seeing a lot of investors actually get quite active again, both big and small investors. And I think in part it's, we are opening up, physically opening up. People can actually meet you in person again. And I know some VCs are, like, they're doing social distancing meetings where you're 10 feet away, but you're talking in person. And then others have gotten used to investing over Zoom. And so at this point in time, I would say, if there's any point in the time of this year between now and the end of the year that's good to raise, I would say now is actually a good time to raise. We're at some sort of local maxima, at least.
Yeah. And do you think it's now because people are kind of trying to get deals done again? They haven't been doing deals, and who knows what's going to happen with maybe the second wave that's happening? Or is it, I'm just curious, why is now a good time, you think, of all of 2020 to fundraise?
Yeah, my honest fear is that we, at least here in the US, like, our COVID cases keep on going up, right? So even though every city in America is basically opening up, I think that it's inevitable that we're all going to have to shut down again, at least for some period of time. I don't know if that's in a couple of months or in the fall or in the winter or whatever, but I think that will happen. There's a high likelihood, and I just don't know when.
Yeah. Hustle Fund has always been cut from a different jib. You started the Hustle Fund, right? Because you weren't happy with the state of how venture was operating and behaving. So you guys have done deals remotely. I think since you started the fund, have you changed anything about how you're operating or looking at companies, or has that pretty much just been status quo for you guys?
It's been status quo for us, but I would say one thing that is different actually in COVID is we've gone kind of the opposite, where, on average, as a
Uh-oh, did we lose Elizabeth? Stand by, everyone. I'm not sure if I'm frozen or if Elizabeth is, or if it's Zoom. Give us 2 minutes here. We're going to try to resolve. Oh, I think she's coming back.
I apologize.
No worries.
What's wrong with my internet?
I
But
played the saxophone while you were gone.
but I mean, so nothing about us has changed except that during COVID, we've actually gone the opposite. We have increased our investments. Previously, I was averaging about, for me writing checks, I was averaging about one company per month pre-COVID. Now, during the last, call it 2 months or so, I've been averaging a check every other day or every other 2 days, which is a dramatic increase. And so we are very active right now.
What about terms? Are those changing given the macro environment, or are terms more or less staying the same?
So terms are weird. Actually, I'm seeing a lot of bifurcation. So in a small percentage of deals, I'm seeing very high valuations, very similar to last year, where, well-networked founders have term sheets for 15 million post money and just a product. And then on the flip side, folks who are less well-networked, I'm seeing valuations drop considerably.
Yeah.
So, seeing 2 million posts, 3 million posts, thereabouts, somewhere in there.
Yeah, that's a huge haircut. And actually I know we said wait till after for Q&A, but I think this one that just came through actually is pretty relevant. So someone just wrote in, first time founder. You kind of have that adage of, venture takes off in the summers and goes on vacation. And then, in the winter around, winter break, they're going skiing. So traditionally summer wasn't a great time to raise. Do you think COVID now has changed that where, we are in summer, but deals aren't getting done? So do you think it's, I guess thoughts on just summer being a good opportunity now to raise, going back to your point around now is a good time?
I think if you're an early stage company like pre-seed or seed, I think actually that's a bit of a misnomer. Like most of the VCs that are not Sandhill VCs, so a lot of the new VCs, whether they're us or even bigger funds, they don't really go on vacation. They can't afford to go on vacation, either financially can't afford to or time-wise, because it is like a startup ourselves. So, definitely the newer VCs are very hungry.
Yeah. Awesome. Well, let's move on, kind of talk about current state, and let's get into some strategy. I loved the video and thought behind this supply and demand. Actually, I think it might even been a tweet kind of thread you had, Elizabeth, and we'll make sure to link it in here in our post. But this idea around supply and demand, and you mentioned, raising a seed round, let's call it $2 million. And that's kind of a weird number, right? It's small angels aren't going to make a dent in that $2 million. But then a larger fund who might write a $750,000 check, that kind of takes a lot of time, right? And so you kind of have this weird hybrid. And you mentioned the strategy you're fond of is splitting this into a tranche. So $500,000 from angels, people that are willing to move quick, write smaller checks, and then using that to go raise $1.5 million tranche after that. Maybe that's a price round from a more institutional fund, but using that to create some momentum. But yeah, I would love just to kind of get, have you give the download on that strategy, why you love it, and maybe why people also don't like it. Because you mentioned, you might be a little bit of a black swan in the sense that this is something you love, but other venture, doesn't.
Yeah. So let's actually take a step back. So when I was a founder before, one of the things I could never understand and that was frustrating was, investors tend to be like herds of sheep. It's like, it's so hard to get that first money. And then at the end, everybody wants in if you have a good raise. But why is that? It seems frustrating, right? And I think now that I'm an investor and having this perspective, I think the lens that we should look at things is like, let's look at it from a sort of pseudo game theory perspective, which is if you're an investor, why should you invest now? And the answer is most of the time you shouldn't. Like most of the time, the right strategy as an investor is for you to wait until there's more information. If you can get in at the same valuation 6 months from now and you have 6 months more information, shouldn't you wait? That's the investor perspective. And so this is why you see investors kind of dragging their feet, especially at the beginning, because there's no forcing function or impetus. So as an entrepreneur, then your job is to create that impetus. And essentially, the only way you can get investors to move faster is if they feel like, gosh, I can't wait 6 months because the valuation will change, because this deal may not be available in 6 months because some other investor took it from me. So what you have to do is you have to basically, and this comes to the supply and demand thing, is you have to generate demand on your deal from other investors. Like that is your job when you're fundraising. And the way to do that is to run a really good process and be talking with lots and lots of investors and try to essentially get them scared of each other. That's essentially what you need to do. Now, going back to your specific example of around 2 million, larger seed rounds like that are kind of challenging because you have a large supply of your raise. Like if you're starting from zero and you're trying to raise $2 million and you haven't made any progress, or maybe you have an angel who put in 25K or 50K, like nobody is afraid that your round is going to be done soon. So it's really hard to get people to move. So the way to try to attack this is, okay, well, can we reduce the supply of our round and generate a lot of demand on that smaller tranche and really get people to move, and then open up the larger tranche once a small amount has been fulfilled. So for example, instead of raising $2 million, maybe you're raising $500,000, and you try to get a lot of investors looking at the $500,000, and then you have more investors who are fearful, where it's like, well, $500,000 is not a whole lot, and I know my friend over there who writes 250K checks is looking at it. If they put in a check, then half the round is gone. So that's the kind of fear you want to generate, and that's why smaller tranches may help. And then once you raise the $500,000, then it's a lot easier to go to the larger investors and say, hey, this is moving quickly. I've already raised $500,000. So then you're able to generate fear from them, which is like, well, I'm now competing with other people who write $500,000 or $1 million checks. If one of them writes a check, then most of the round is gone. So that's the mindset I think everyone needs to be in.
Yeah, I always tell a lot of our customers and people in our community, investors are really incentivized not to invest in your company. They can just wait as long as they want to see how you progress and how your round comes together, or how your business grows or doesn't grow. And so creating that FOMO effect is huge. For some questions around the 500K example from smaller angels or micro funds, and who's setting the cap there? Is that coming from the founder? Is that kind of consensus groupthink? Like, where is that? I think it's clear for at least $1.5 million that an institutional investor is going to want to set the price or terms there. But for the $500,000 component, is that the founder saying, hey, I'm raising at this valuation? Are you trying to figure out what the market's saying? Like, who's coming up with the terms for that first tranche?
Yeah, great question. So over the years, I think one of the neat things about the fundraising landscape is that founders have so many more options now. I mean, in the 90s, people were just sitting around waiting for a VC lead to say, here, we're going to do this on an equity basis. And then later, people started using convertible notes. But now, I mean, you could use convertible notes, or you could use safes, or 500 has the KISS doc, whatever it is. It allows you to move with speed rather than waiting for all these people to come together for an equity round. And you can set the valuation yourself on the 500K. Now, in terms of, I often get asked as the next question is like, well, what number do you pick as your cap on the safe? And I mean, I think this is where I'm a big fan of something that I call the tranche strategy, which is what I outlined in this tweet storm, which is, okay, if you want to get momentum on your raise, one lever that you have is your valuation. Investors will be more interested if they like your company to move if the valuation is lower. Now, what lower means exactly is honestly relative to what other deals are on their plate. So, in the last recession, I would say a high valuation was actually 2 million cap when I was raising.
Okay.
Right now, I think, it will vary a lot by geography and how well networked you are, but I would ask your friends, as like your entrepreneur friends, as a good indicator, your entrepreneur friends who are in your local area, like what they're doing and what they're seeing, as a good indicator of how you should set your cap. That, I think, is the best way to figure out what is market at that place in time. And
yep.
I would
sorry, go ahead.
Oh, one last thought. I would generally try
Yeah.
to set that number to be slightly lower and then create a small tranche. So if it turns out, gosh, you underpriced it because everyone all of a sudden is, wanting to do this deal, that's a good signal to you because it means that on the larger tranche, you can go for a larger valuation or have more negotiation power on on a higher valuation. But if you set it at sort of a low cap and nobody wants in on that small tranche, then you have a big problem where it's not about price. People just don't want to invest in your company. And that's what you have to
Yep.
solve for first.
Yep. Let's get into that. So, no one wants to invest in your company. What do you do next? How do you figure out, is it a founder market fit? Is it product market? Like where, how should founders think about like, hey, no one wants to invest. Then what do I do?
Yeah. So I actually see this as very akin to a customer discovery exercise. If you are legitimately talking with enough investors, certainly if you talk with 50 investors who are at your stage, or even let's say 20 or 10, like if you've had those conversations and nobody, like 0 people want to invest, I would really try to ask all of those people, hey, can you give me some feedback on why you're not participating? That would be very
Yeah.
helpful. And investors are kind of cagey, so some people may not, but you may get little nuggets here and there from a handful of people, and that could be incredibly valuable. And I think, common reasons are, we think this space is very competitive. We think this is not differentiated enough. We think that your go-to-market is going to be really hard. We think that your total addressable market's too small. We don't think you're the right team for this problem. Whatever it is, if you can get like pieces of feedback, that could be really helpful. And if you hear that piece of feedback twice, then I would think that probably many investors are thinking that, and you have to somehow address that.
Yeah.
And sometimes you can't address it. Like if you are building a product in a competitive space, actually, I'll give you an example. I saw a tweet storm this morning. I was just very impressed. This company has grown to basically $1 million run rate subscription product in just the last few months, profitably, entirely bootstrapped. So I dug in and I looked at what product they're offering. Like they were basically saying YC rejected them, and the fundraising gamut was hard. And the product that they have is a product that actually I've seen so many entrepreneurs go after. And my first thought was, VCs would say that this is a very crowded space. But it's not to say you can't build a great business out of it, as they clearly have done, right? They
Yep.
own their own destiny, completely bootstrapped at $1 million run rate, profitable, and in subscription repeating revenue. So it may be that you cannot raise VC money, but it doesn't mean that's a bad business. And it doesn't mean you should pivot to something that VCs want. It may just mean that you need to get to a certain level to get to other types of financing.
What kind of company was it? You've piqued my interest.
Yeah, it was basically a video editing app.
Okay. Yeah. I mean, look at Zoom. Zoom you would consider Zoom to be in a hyper competitive space when they launched, and now they're the de facto communication tool for the world. So it's pretty funny how that works out sometimes.
But even if you're not de facto, I think markets are so big these days. Like, let's take this video editing app. Like, I've seen many video editing apps, but this company, like, I think that they can probably get to 10 million run rate bootstrapped. Yeah. But I think VCs will still not touch it.
Yeah. Well, we're going to have to dig into that in a second on the next slide of why that's happening. But one thing I want to talk around this idea of supply and demand, we've talked about tranches in terms of kind of testing at 500K and then rolling that into a larger round. One of the things we talk about at Visible is this idea of sets, right? Like if you need to talk to a bunch of investors, because at the end of the day, it's a numbers game, and put people through this so you can kind of get that feedback, whether it's feedback on terms and price, feedback on what's wrong with the pitch or the business. In terms of, you mentioned, talking to 50 investors, how do you think about your investor funnel and just maybe process in general? Is it full-time, I'm doing this, over the next 3 months and it's gonna be my full-time job, and I need to put 120 people through the funnel? Should I treat them in sets, put a cohort through, kind of see what shakes out, maybe pivot my pitch or something about my business and put another cohort through? Like, what do you like to see in terms of just high level strategy, Elizabeth, when it comes to maybe not strategy around the round, but the funnel for your investors?
Yeah, it's very akin to a B2B sales process, but
Yeah.
most people don't think about it that way. So what I advise my founders to do, and this is really challenging, especially when you're such an early company, but I really think that the way to do fundraising right, if you're going to do it, is to do it full time. So it means
Yeah.
that you're not working on the business, and it could be many weeks where you're not working on the business, and you somehow have to have the rest of your team like cover you basically. And that can be very challenging if you are the CEO and you're also the salesperson or the customer acquisition person on your company. Like how you juggle that is a challenge. And I don't have a great solve for that. But I think that's what you have to do because again, it kind of goes back to creating urgency for investors. So if you're just like splotchily taking a meeting a week or a couple meetings a week with an investor, you can never create any urgency on the deal. Even if you're a great company, I've seen so many founders just not be able to close the round that they want because they don't have any leverage in that scenario. And so the ideal scenario is you are taking 20 meetings a week, like literally, 4 meetings a day. Maybe they're spaced out by an hour, so you have time to process and switch, but you want to have that so that way you can do the meetings and then basically tell all the investors, hey, now we're going into second meetings. Do you want to continue this process with us? And then you force everybody into a second meeting with you. And then now you tell everyone, hey, we're going into all partner meetings or final decision maker meetings. Where are we with your process? And just like push everybody along with the impetus really being about you're having a lot of meetings and nothing else. Because in the beginning, you don't have anybody committing to you, but what you do have is momentum of people meeting with you. And that's what you need to leverage when you're just starting to raise.
What about when you're not fundraising? Like, should I be building relationships or nurturing people when I'm not in a current fundraising cycle? So, call it I've got 9 months maybe to my next raise. How should I think about relationships and finding those investors for a future fundraise? Call it I've raised pre-seed, now I'm going to seed next. Like, how should founders think about those relationships and connecting those dots with investors?
Yeah, my own thinking has evolved on this. I think for pre-seed, seed, post-seed, basically any stage where you are raising on notes or safes, or where you could potentially be raising on notes or safes, I think that it is important to just be focused on the business and not worry about investors. These days, a lot of investors in these stages move very quickly and don't feel like they need to build strong relationships ahead of time. But if you are coming up on your Series A and that's your next round and you're talking about raising $5 million and somebody's going to take your board seat, it's a two-way street. You do want to get to know these people as people because they're going to be sitting on your board for years and can really make your life hell and can even potentially fire you if you're not aligned. So I think if you're coming up on a bigger round like that, an in equity large round with a board seat, I would start building those relationships basically right after you finish raising that seed or your post seed in order to both ways build a relationship ahead of time.
Yeah. Awesome. One last question here before we move on to talking about kind of how VCs think and some portfolio construction, just so we can get to that. But I want to talk about time real quick, just the construct of time. What should expectations be for founders from, let's just go back to that tranche that we keep talking about, the 500K and the 1.5 million. What should be my expectations for time in terms of how long that actually takes, right? Is that weeks, months, half a year? Like, how should I think about time as it relates to a fundraise? I tend to think that we as founders underestimate the amount of time it just takes to actually get a raise done and completed.
It takes forever. So I think even in a good raise, it will certainly take weeks. I've seen anomaly raises get done in like 1 or 2 weeks, but I would say those are anomalies. The founders were super well connected, very rich in themselves, and have had serial, successful exits. So, but if you are not one of those people, and even if you have one of those components, it will still take weeks. So, and the reason again is it just takes weeks to do the meetings to create enough FOMO.
Yep.
And it will take you at least 2 weeks to do enough meetings before somebody is actually interested and for you to be able to, herd all these sheep together. So doing meetings in itself, if you're doing it right, back to back to back to back, like you can take 20 meetings in the first week. And I really think for pre-seed or seed, you need to be shooting for, maybe you don't get to these, but shooting for like 50 to 100 meetings. So you're talking about doing at least 2 weeks of full-time meetings. And then after that, a lot of those people will want to meet you again. And so then you're going to be meeting with them again in weeks 3 and 4. And so you're talking about a month of just doing meetings. And then they'll have, if they're a VC, they'll have an all partner meeting to decide themselves, or they'll think about it. Or if it's an angel, angels have day jobs. You
Yep.
are not their number one priority, and investing is not their number one thing. So you are competing for their time, and that can just take some time. So a month to do meetings, and then maybe another month for decisions and paperwork and all that in a very good process.
Yeah, legal work alone is a huge slug of time.
Yeah, that can take forever. Like I'm in the middle of 2 deals right now. Like usually when we are first to a deal, we'll just sign on a safe for expediency. But there are 2 deals right now. One is an equity round. It's probably taken 3 or 4 weeks just on paperwork, even though we committed immediately. And then the other one is a convertible note. And that is, for whatever reason, it's not our note, it's another investor's note. And so we're waiting on them to finish that. So anyway, it's just crazy.
Once you herd the sheep for all of the meetings, then you got to herd them all again for the legal work. It's crazy. Awesome. Well, let's talk about, we talked about managing sets. Let's talk about understanding how VCs think. So I think this is super important for founders, just to understand the venture model, because at the end of the day, I'm selling to an investor who's probably selling something to their investors, right? And which is equity and then carry my fund. But I think one of the things that founders don't have a great sense of is how venture works in terms of why do VCs need unicorn exits, right? Why do they need these, billion-dollar outcomes and what that means for founders? So can you just share a little bit? And I'd be curious to hear, like, you've mentioned quite a bit around the hustle fund. Like, are you guys looking for that unicorn, or do you guys have a different thesis when it comes to portfolio construction on top of that? But maybe just talking about power law and why this is kind of how venture works, and why founders should dig in and understand the venture model.
Yeah. So I think it's very important to understand how VCs make their money, because everything kind of stems from that.
Yeah.
So, I mean, essentially, you make the most money ideally by making good investments, and then you put in some money into these companies, and then they return for more than that money to you. However, as we all know, that doing startups is a very risky thing, certainly for the founders and investors who are along for the ride. They may not make any money. They may lose their money in many of their portfolio companies. That's just the nature of the game. Like, startups don't have a high probability of success. And so I think if we take the old adage of, 9 out of 10 companies fail, on that one winner, when you think about it, they not only have to win, but they have to make up for all of the losses in the investor's portfolio. And that's really hard. Like, you're making up for 9 other failures and you've got to win. And I think if you further do the math for VCs, they're not just looking for an overall portfolio positive exit. They have to beat other comps in the market, because VCs raise money from other people. And those other people could be putting their money in the stock market, the public stock market. They could be putting their money in real estate or all kinds of things. And so VCs are looking for returns that will make their entire portfolio exceed many of those other benchmarks. The public stock market actually generally does pretty well over the long run. On average, the public stock market over 10 years will double. Obviously, not all the time, not every decade, but on average, will double in 7 to 10 years. So if a VC's portfolio is only returning 2x, that's not good enough, because you would much prefer to put your money in the public stock markets, which is liquid. You could sell anytime, your index funds, right? So that's why it's really hard. And I think if you further do the math after dilution and all this other stuff, basically VCs need to look for their one winner to return 100x. And by return 100x, I mean like if a VC is getting in at 3 million post-money valuation, they need the company to exit for at least 300 million. Because after dilution and all this other stuff, like that's what it takes for that one winner. And that's hard. So for us, we're not looking for $1 billion exits per se, but we are looking for that 100x. So if we can control the entry point to be lower, then our expectations of what we think a company may be able to do or hopefully will do is lower. But if a company comes to us and says, hey, we're raising at 10 million posts, which is what a lot of YC graduates say, it's a lot. It's a really hard decision because most companies are not going to be able to sell for $1 billion.
Yeah, that goes back to the entry points, right? That and I guess maybe back to what we were talking about, that first tranche in terms of pricing, where that actually matters for portfolio construction, right? There's actually a big difference between $3, $5, and $10 million because your expectations for exit are very different. Because, like you said, $300 million exit looks a lot different than a $1 billion exit.
Yep. And so actually, I mean, this kind of comes back to why we've been very active in the last couple of months, where, you know, if we're seeing companies at lower valuations, our expectations for exits are lower. And if, you know, it seems like a sharp team and they're going about it in a certain way or whatever, it's easier for us to get behind. If you're pitching us like, hey, we have a deal at 15 million posts, like there's a lot of questions there about, you know, from our side, like the bar is just a lot higher.
Yeah.
So you know, we certainly have run the gamut valuations wise in terms of what we have done. I would say our bread and butter tends to be lower valuations, not always, but tends to be. But that is how we think about it when a company, you know, comes to us with how they're thinking about valuation.
Let's talk about hustle for a second. So you mentioned bread and butter. One of the things that Hustle Fund is all about is hustle. What is that commonality you believe and you see in founders that are successful? What do you think? You know, what do you look for in founders with the Hustle Fund?
Yeah, so I would say first and foremost, before we even talk to founders, when we go through our process, we look at companies based on the ideas themselves. In fact, we don't even dig into the founders' profiles, and that may or, you know, people have different schools of thoughts on it, but yeah. I have a very strong school of thought that being differentiated in a non-competitive space is a huge advantage for investors. And so we tend to shy away from very competitive areas, and we'll often turn away, I'm sure, very great founders if they're working on something in a very competitive space or they're not very differentiated. Like I mentioned, like the video editing. Yep. Yeah, you know, a founder can build a great business out of it, but is it going to get me 100x? It's very hard to navigate competitive spaces and get 100x just from my past experience and looking at the data. So we actually triage by idea first, and then once we have a conversation with founders, then we dig more into, okay, the traits of the founder. And I think, you know, the best traits of founders, at least at the early stages, and kind of where Hustle Fund comes from, is we're looking for founders who can execute with speed and have relentless focus. And I think that's a very important distinction, because I think when a lot of people think about the word hustle, they think about, oh, I'm working hard on 50 different things and I'm staying up until 3 a.m. But that's not what we mean by hustle. Like, the best founders can really, you know, focus on just like the most important thing and pretty much ignore everything else.
Yeah. And
really get a lot of velocity on execution of that one thing. So if it's customer acquisition experiments, that's all they're doing. And they may be ignoring, you know, emails from, I don't know, other partners or whatever, if that's not their main thing.
Yeah. I'm going to jump the gun a little bit on questions. That was one of the questions, but real quick, going back to, you know, we talk about fundraising, this comes up quite a bit. What if I can't fundraise? You know, how do I split my time now between maybe fundraising, profitability, cash burn, we're growing and retaining customers? Like, what if I just can't raise right now? What should I do? That's a loaded question.
Well, I mean, having started my business during the recession, and many of my peers and friends that I made during that time also could not, you know, I have a very skewed perspective on it, I think, compared to many other VCs, which is, I'm a huge fan of sort of a bootstrapping mentality. I mean, even the founders that we fund, tend to not raise very much money, or, you know, they tend to keep their burn quite lean. And I'll give you an example. One of my friends' companies, NerdWallet, who also started during the recession, the last recession, they also couldn't raise any money. And really then, if you can't raise any money, like I think the key thing is to hone in on, okay, how can you make money with your business? I mean, at the end of the day, that's what it's about, like in building a business, right? Like how can I get to revenue very quickly and now? And so that would be my recommendation, like just expedite getting to revenue immediately. And for them, they couldn't raise for many years. They are a unicorn now, actually, but mostly bootstrap because nobody would fund them. So it's not a bad thing that you can't raise money. It doesn't mean your idea is bad, but you got to get to revenue.
Yep. Awesome. How are we doing on time? You got a couple minutes for questions?
Oh, I do. Yeah.
Yeah. Awesome. Great. Fantastic. So like I said, if you have any final questions, we've been grabbing them all, so we'll go through some now. We will send out this recording and recap after. Let's go through some here. So, okay, first question. You mentioned well-networked founders can raise at higher valuations, have an easier time fundraising. We have a new founder yet to build a large network, especially during COVID, right? Harder to meet people. How should I go about finding other investors or network or networking in general, right? So it's hard right now. How should I build my network? I'm a first-time founder in this environment.
Yeah. The great news is that you know, I think these days it is a lot easier. I wouldn't say it's ever easy, but it's a lot easier if you're not networked. So here are a few thoughts. One, there's a boatload of accelerators these days compared to even 5 or 10 years ago. Certainly they're the behemoths, you know, YC, Techstars, 500, Acceleprise, Alchemist, you know, the list goes on and on. So that's one, and they all are well networked. The second is, if you don't want to go the accelerator route, you know, every VC is on Twitter now, and so many of them, you know, chat with everybody and anybody. So it's easy to kind of build relationships online. I know I've met a lot of people, both founders and other investors, just through Twitter. Never met them in person, but I feel like I know them quite well. Thirdly, a lot of VCs are taking cold emails. Certainly angels do as well. If you write a good cold email, very concise, to the point, like what's in it for them, people will respond. Not everybody, it's a numbers game, but I think that works well. Fourthly, what is really new, and I'm seeing kind of crop up, is there are a number of, I don't know what you call them, I call them like tech influencers, but there are people who are not VCs, but they are in this ecosystem. And what they're trying to do is basically do some matchmaking. So Lolita Taub is a good example. There's a couple of people come together to do something called first dollar deals. And essentially it's like a matching thing. You fill out your company in a form, and all the investors have filled out forms with them. And then they essentially send out matches every week. So I get an email from each of those groups every week with a list of companies that may be relevant to me. I would say that they're fantastic because all of them are 100% in like my zone of what I'm looking at. It's like, you know, the geographies that I serve and how much money people are raising and what kind of idea it is and stuff like that. Like it's been really great. And so it's a good way to get in front of a lot of investors. And I think that that's a great set of initiatives. Just look on Twitter for that. And so I think there are several options people now have that they didn't have before.
Cold email, that you touched on that, and we had a question come in about cold email. You mentioned concise, what's in it for you. Anything else founders should know about cold email as a strategy in terms of what works best?
I would recommend everybody sign up for my blog, Elizabeth Yin.
There we go.
I do have a couple of articles on that specifically, like tactics.
Yeah, we'll link it here and in the recap for the blog. Which is fantastic content, by the way, and the videos. I watched a bunch today before we jumped on here.
Oh, thank you.
Awesome. One more question, and then we have some specific questions for the Hustle Fund. So let's see here. Should I use a bottoms up or top down approach to modeling my market for potential investors? So market size. I think market size comes up all the time, right? Is this big enough? We don't think the market's big enough, or you can get a bigger big percentage of the market. So what's your advice to founders thinking about TAM, bottoms up, top down? Does it even matter?
So I think for many investors, it matters. For me, it, frankly speaking, doesn't matter. I think at the end of the day, though, what I've seen is it's very subjective, whether it's from the founders or the investors themselves. I think people generally have an intuition of, oh, I think this is a big market, or I think this is a small market. Whether it's a correct intuition or not, it doesn't matter, and it's hard to change somebody's mind. So then I think everyone does this sort of pseudo fake exercise of like trying to market it out, like market size it out, but it doesn't really matter because everyone's made up their mind anyway. So I think I would just say do the best you can. If people say it's too small, maybe you try again, but I think it's just not the right fit for you. And that's why it's a numbers game to try to find investors who are actually interested and try to convert those people. Don't try to convert people who are not even remotely interested.
Yeah, I think that's spot on. I mean, even if you look at Uber's original pitch deck, it was like their market size is like a fraction of what Uber's market size is as of today, right? Like they're modeling like the taxi market in the States or whatever, and it by far blew that away even with their market size as a business. So I find that market sizing is just really tricky, and just find people that think the market's big because it's hard to convince someone otherwise.
You can also cross-sell as well later on.
Yeah.
So, anyway.
Yeah. All right. Actually, okay. What constitutes as a pre-seed round? We talked about that before. What needs to be in place? Like, what does a pre-seed round mean? I mean, it's always a moving target, but what does it mean today?
Yeah, I mean, I would say roughly $500,000 raise. Generally you have a product or something. You've done something. I think if you just have an idea, I think it's just going to be really hard to raise from anybody except for maybe your mom. Like if I'm going to be honest, even from angels, I think people want to see something. And so I would say pre-seed is you have something, but maybe not loads of traction. Like seed, I would say, for example, would be you're doing $10,000 per month in revenue. And so anything kind of under that would probably be pre-seed in my book.
Okay. Very fair. All right, so final two questions. Again, everyone, thanks for joining. We're going to send out this recap. Elizabeth, thank you so much for joining us again. Two questions. One, do you invest outside of the United States? And two, how can people pitch the Hustle Fund?
Yeah, so we do open applications. You can just go to hustlefund.vc. We do look. Admittedly, we're a little bit slow, but we do get back to everybody. So if you haven't heard from us in, call it a month, ping us because we may have inadvertently dropped your application or something. It's not a bad thing to ping people. And, we actually, we have funded 15% of our companies in our portfolio are people we did not get referred to or referred by from anybody. Like they came directly on that application. So we do a sizable number of investments. I think even if you are referred in, I will still send you to that application form anyway. We will of course count it as a referral in our own books, but that's just kind of what we do. And then the other thing, what was the other question?
Do you invest outside of the United States?
Oh yeah, so right now we're not truly a global fund. We invest in the US, Canada, and now in Southeast Asia. I think someday we would like to go global, but we don't, as a small fund, we don't have the resources to do that.
Awesome. Well, again, everyone, we'll put these resources together, hustlefund.vc if you want to jump over there right now. I can't say enough great things about getting to know the Hustle Fund team and Elizabeth over the past couple of years. They've been a great partner of ours and truly thinking about venture in a different way, which is a breath of fresh air. And so we love having them on and being part of our community. So thanks to everyone for joining. Elizabeth, thank you so much for the time. We'll send out this recap, but I hope everyone has a great rest of their day.
Thanks, Mike.
All right, see ya.